Hello, welcome back. This is Seewing Yee, and I'm going to compare stock market CDs at 4% versus income property. Is it a apple comparison or apple to oranges comparison? All right. So a lot of misinformed people think the stock market return eats the cash flow, the allegedly the low cash flow associated with owning a rental property. So I'm going to do a real life example and give you the true perks. Hey, all right, here we go. CDs, okay? CDs versus rental property. Apple to oranges, not apple to apple. A CD, let's say, but it earns you 5%. It doesn't have to be a CD. It could be a money market, could be bonds, could be a stocks. Yeah, stock market are on a historical basis. Let's say 5% for the sake of discussion. The example, the scenario I'm doing is put $20,000 of your money into CD, earning you 5% on annual or on a yield. So that give you like around $100 per month or $1,000 per year, the first year on your return on your investment. Okay, does it make sense? All right. On the other hand, let's put $20,000 of your hard-earned money into buying an income property and do the actual comparison, right? So here we go. The example I'm using here in property in the Midwest is a totally rehab property. Everything's path inspection in Midwest, no collar. Again, all rehab, everything's has been updated. He's already rented. So this is a duplex, $69,000 on today's listing. Both units rent for a total of $1,350 rent. So each door rents for approximately around a little bit less than $700 per month, those rent. Of course, someone, again, the, the benefit of income property versus stock market is you have the power of leverage among many other benefits that a stock market investment does not have. So you do a leverage at 25% down payment, even with a mortgage rate of 6.8% to 7%, then you get a finance and you minus the debt service, the monthly debt service, as you see, taxes, insurance, the whole 9 yards, property management fee of 10%, and you minus all the vacancy rate, the management fee of 10%, and the annual maintenance costs that come out of it, and a 3% annual appreciation rate, all very realistic and very conservative, all these numbers. Okay. At the end of the day, of course, your mortgage is 340, and given all that, so your monthly net cash flow is approximately $616. I know a lot of people feel in today's market, cash flow is very hard to achieve. That is very true, but if we're talking nationwide, but every market every local market is different in real estate, as you may or may not know. The, the benchmark for rent to value ratio is 1%. 1% of the purchase price equals your monthly gross rent. That is ideal for high cash flow scenario, financing. However, in this particular case, you're getting 2% rent to value ratio, which is absolutely unheard of these days or any days on a historical basis, on this particular property. So right off the bat, we're financing this 2% rent to value ratio, 2% multiplied by the purchase price, 69,000 on his duplex equals 1,350, right? Very extremely high benchmark, which cannot be matched, as far as I'm concerned, anywhere in the country on the current environment or in fact, in any environment. At the normal capitalization rate, again, I'm not going to go over the formulas. It'll take hours to explain. I have other videos that will explain this type of numerical formulas in a much, much more detail. Just log into my email, subscribe to my email database, and also watch my YouTube channel. But the benchmark, the minimal benchmark for cap rate is around 6 to 7%. But we're getting almost triple that normal capitalization rate on this particular property, 16.6%. And the cash on cash return at 35%. The benchmark for investment property, the benchmark for cash and cash return is probably 7%. So this is a 5 times X the normal cash on cash return. Okay. And of course, the total return at the end of the first year is 47%. That's right. I did not stutter, and this number are correct. You're getting a CD, a money market, or stock market at 4% yield. This total return on investment at the end of the first year. There are many more years to grow with this asset at 47%, 47 whopping percent. So how many times greater return on this property at the end of the first year versus a 4% CD money market or stock market? 4 divided into 47, you get a 10 times your money. You're making return 10 times more than the stock market. Okay. How do I arrive at this 47%? Let's break it down very briefly. Okay. The benchmark is your down payment, a little bit more than 20 grand. Okay. Including closing costs, by the way. So the annual net cash flow is 616. The annual net monthly cash flow, 616. Annual net cash flow at the end of the first year is 7403. So 7403 divided into 21,250, your initial cash invested equals cash and cash return of 35%, right? Simple math. Am I right? 3% appreciation at the end of the first year, 3% multiplied by purchase price 69,000. The end of the first year, your equity gain at the end of the first year is $2,070. And also with that, we have not even talked about the tax saving. Okay, you get depreciation, tax write-off that this software cannot calculate. All right, so just leave that alone. Okay, and then anyway, your annual net cash flow 7,400 plus first year appreciation, equity growth. The end of the first year at 3% growth rate, 2,000. All right, plus your what else? Anyway, equal growth, equity income in this case, 3 plus the principal reduction benefit. Now, I don't know how to explain that one, 538 on a first year annual basis, plus your first year appreciation is 27. These three numbers combined equals 10,000. A little bit under 10,000. So 10,000, your first year total return from these three metrics divided by your total money invested, 21 grand by leveraging equals 47%. Only the first year. Imagine for the remaining 10 to 15 years, I'm not going to go over those areas. But at the end of the day, 10 times the earning of the stock market. No, that's more. By the way, the housing market in Buffalo is robust. And Buffalo, New York is ranked number 1 in 2024 Zillow's top 10 hottest housing market. All right. So I rest my case. The stock market at any time versus real estate in the way I explain it even on historical basis, long-term 100-year basis, real estate always beats stock market. Because why? Because real estate, there are 5 ways you can make money. Cash flow, increasing cash flow due to inflation, debt paid down by the tenant, capital appreciation over time, 5-10 periods, around 5% annual appreciation rate on a historical basis with real estate, and tax benefit. Some people get more tax benefit than others. And with the power of leverage of using a 30-year fixed rate mortgage, where your mortgage payment is fixed for years to come, and let the tenant pay down the debt, whereby it will be very clear down the road, so you will growth exponentially by having a no debt eventually, right? So 5 ways to make money in real estate, where there's one way most of the time to make money in the stock market, CDs, money market. All right. So I rest my case. Please comment below. What do you think of my initially supposed to be an apple to apple comparison? Now it's no longer apple to apple comparison. It's apple to oranges comparison. So income property, clearly short-term, intermediate term, and long-term will be stock market. Okay. I know some of you are thinking, I don't agree. Make comment below. Let me hear what you think. Okay. And all right. So if you receive any value from this video, please like and subscribe to my YouTube channel, and also put your email, subscribe your email into our website so you'll become a free member of our real estate investment club. So you receive free email contents around real estate investing, the whole 9 yards. Thank you so much. This is Seewing Yee. Thanks for watching. I'll see you in the next video. Bye bye.